Oh, welcome back. Dennis Gibb joins us once again, one of the great friends of our show. And, after establishing Sweetwater Investments in 1989, he's gone to $1.4 billion in assets encompassing a range of clients. And Dennis, when you work with as many people as you do, you see a lot of people screw things up, don't you?
All the time. And the thing that interests me is that we see people who screw up who are willing to admit they've screwed up and come to us for help. I just think about all the people out there who've screwed up and won't go to anybody because they're too proud to admit their mistakes, and they suffer along rather than paying somebody to help them out.
And so when you start talking about screwing up, and I love how we're going to just call it that,
sure.
You're really talking about people who maybe made a lot of money and lost it, or just continue to not be able to create a plan that's effective for them, right?
Or they make mistakes in the way they invest. They chase stocks around that they shouldn't be chased. They figure the next highest stock. Again, it's somebody's brother's cousin's second nephew made $800,000 in Microsoft, therefore I can make it. It's never
nobody
anybody.
Told them they bought in '86.
Yeah, it's never anybody you know. It's always somebody's brother, sister, or some person that you don't, probably not even blood related, but they always made money, and so everybody's got these stories they're chasing, and they don't think whether that's the right story for them or not.
So, really, I think that's a great way to put it. It's not their story.
No.
It's like me saying, well, I'm going to go invent a social network.
Yeah, well,
I heard this guy did it. He called it Facebook. I'm going to call it, I don't know.
Yeah.
Something else.
Yeah, whatever. I mean, it's true. And you have to play to your strengths. I mean, not everybody approaches things the same way, and not everybody thinks about things the same way. So you have to talk about what you know, and you have to go back to, Shakespeare, who said, this above all to thine own self be true. If you're not true to yourself, you'll never be true to yourself as an investor.
And so as an investor, what are some of the biggest mistakes you see people making?
Well, there's one. The first one is the issue of fees. Now, first of all, for a guy who is compensated solely by fees, as we are, we'll say that every fee that Sweetwater charges is completely justified and well earned. But people pay a lot of money in fees. Mutual fund fees, sometimes are 1.5% of the money invested. They'll get into limited partnerships where 4 or 5% comes off the top end right away, and 3% annually. They'll get into all these kinds of things. And that may be okay when the market's doing 25 and 30% a year. But when it's doing 4, 5, 7, 8, knocking a point off or a 1.5 off on an investment, that changes your whole characteristic. And over a 20-year period of time, fees are an enormous drag. They're probably the largest drag on performance and success in financial planning or investment of any kind.
So how does somebody, everybody gets paid in some way or another. Mm-hmm. How do you avoid getting dragged down by the fees?
Or drugged are what people do when they take this stuff. They get drugged and they get dragged someplace else. It's not so much getting dragged as it is not being aware. You can go online to Yahoo or to Morningstar or any place like that with a mutual fund, and their fees are right there. So, if you're going to invest $100,000 and it's 1.5 on a fee, you get a pretty good idea you're paying $10,000 or $15,000 a year. So the idea then is to go out and find another mutual fund that doesn't charge as much. And you're trying to drive down your fee without losing your performance.
So if you're out and you're looking and, you don't want to pay fees, and then maybe the next best thing is, well, I'm going to at least go try to find the highest paying investment, right? Isn't that something people do?
That's probably the second biggest mistake people make is they reach for yield. They either reach too far out for the yield, the promise of the future, or they go down the quality scale. For example, in bonds, they'll go down to junk bonds, they'll go down to defaulted bonds or whatever, thinking that they can make more money. Sure, 13% is more than 7, but that 13% comes with a big risk. And if you're looking out there in an environment like we have now, where the 30-year U.S. Treasury, which is supposedly the risk-free rate, is somewhere in the 2.5 range, and something's offering you 18 or 19%, you need to be a little careful, because there's a reason that nothing on Wall Street occurs without a reason. And if it's that much higher, there's some risk associated with it one way or the other.
Do you think that people go out and they just see the number? They see, I could make X amount, and it's the greed that kind of kicks in.
Well, I think greed's all part of it, and people. investments are only made really for three separate reasons: fear, hope, and greed. And people get greedy when they chase high volatility stocks and high PE stocks. They think they're going to make a lot of money quick. And they chase yield right now because they think that's going to give them a perspective. And, fear is that they're not going to make their goals. They're going to end up, eating cat food when they're 65. All of those are social behaviors which are damaging to you as an investor.
Do you think that people can avoid those somehow? I mean, it's built into the psyche a little bit, isn't it? Or are we our own worst enemies sometimes?
Yeah, we are. Most investors are their own worst enemy. I mean, there used to be a comic strip years ago called Pogo, and Pogo said, we have met the enemy and they is us. And that's exactly right. Our own behaviors oftentimes and our own learning hurt us a lot. We tend to look at things the same way all the time. We don't look at new facts. We discount fact. We have a thing called confirmation bias, where if we want to see red cars, if we're thinking about seeing a red car, all we're going to see driving on the street are red cars. It's going to confirm what we're doing. And it's the same thing in investing. People confirm their own prejudices, that they just won't look at other data. It's called the hidden lion syndrome.
The hidden lion syndrome. What about, you sign up, you get on an email list, right? Mm-hmm. And all of a sudden, it's, this guy, this penny stock, made 4,000% yesterday. Sure. How did I miss it? How did I miss that one, Dennis?
Well, listen, I can't tell you how many I've missed over the years, and I've always, and it's interesting, you only ever hear about those ex post facto. People will come to you and say, okay, they don't come to you and say, hey, I got this great story. They tell you afterwards because they're trying to get you to buy the next one.
Right.
Okay. So everybody can go out and I knew a guy one time who had a large account base, and he would buy these small stocks. And what he would do is he would put his new clients in first. Then he'd bring his other clients in behind. And he would drive the stock up with his own buying. Then he would take the clients out in reverse order. So the new clients thought he was making a ton of money, and really it was his own buying. So, penny stocks are manipulated. They're all manipulated. And, I mean, there's never been a penny stock that's really made 4,000% unless somebody was out there twisting the game. So those kinds of things are just dangerous. And people say, well, yeah, but I'm only going to lose 4 cents. That's 100% of your money.
Right?
I'm sorry. That's 100%.
Unless you buy one share, in which case you were only going to make 16 cents.
Exactly
so it really
right.
didn't make much
Exactly
difference
right.
to go with. What about the funds that you can buy?
Well, probably the greatest investment innovation in the last 30 years has been the exchange traded fund. And this is basically a mutual fund. It's what's called a closed end fund. It issues a certain number of shares, and it trades on the exchanges. So you can buy and sell it on a daily basis. With an open end mutual fund like PIMCO or something like that, you can only trade it at the end of the day, at the net asset value of that day. This thing you can buy and sell all day. You can sell them short. You can do options on them. You can do a lot of different things. And they have much lower fees. In many cases, you can buy, for example, a fund that buys large cap growth stocks where the fund that does it may have a point charge. The one you can buy as an ETF will have like a half a point. So you're saving that much money that fast. And it's really, they're really very innovative, and they give you a lot of chance to participate. Most of the people who participate in gold participate now through one of the gold ETFs rather than buying gold themselves.
We're here with Dennis Gibb, president of Sweetwater Investments. Dennis, we just have a couple minutes left, and I want to get through a few of these. We talked about picking penny stocks. Is that an issue, picking stocks at all?
Yeah, picking stocks, most people don't do it well, just frankly. So the asset allocation.
Is the monkey at the dartboard, is that a true story?
Well, it can work, yeah. I mean, theoretically, it can work. And then, unfortunately, there's a lot of monkeys out there doing that, and they're getting paid a lot of money. The point is that most people don't know how to analyze the stock. They don't know how to look at the accounting. They don't know how to look at the basic business structure of the company. So asset allocation, how you distribute your entire money over your investment profile, is really more important than the individual stock. If you can get the asset allocation right, if you can get whether U.S. stocks are going to do better than European stocks, or whether the S&P 500 is going to do better than the small cap stocks, you'll gain about 90% of all the advantage you have in the market. Asset allocation is extremely important.
And that's really keeps it safe and growing rather than
diversifies, keeps your risk down, and gives you a lot upside.
What about the way people manage their money? I mean, there's a lot of different management types.
Mm-hmm.
I mean, do you think of that? I mean, that's got to be a huge mistake. People get overly involved.
Yep, over-involved or uninvolved. There's passive investment, which is where basically you go out and you buy the Standard & Poor's 500 index fund or something else, and you just basically sit back and let it go. Then there's active management, where you're buying and selling based upon valuations and stuff like that. Active management requires real expertise, and it requires a great deal of time. I tell my clients all the time that every one of them is smart enough to do what we do. They just don't have the 14 hours a day to devote to it that we do. And it's just like hiring somebody to do work at your house. I mean, yeah, you can do it, but you might end up, electrocuting yourself or chopping your fingers off or, creating a biohazard in your house or something of that nature.
That's true. Dennis, we just have a couple minutes, a little bit of time left. I want to get into this one, though, that you talked about confusing past performance with future potential.
Right.
And, you talked actually that you brought this to our attention and all of our listeners' attention with Apple. Mm-hmm. You said if Apple continued on the pace it was going, it would take over the world. It would own everything at some point in time. So it's not possible.
Not possible.
That's got to be a big piece of this, confusing the past with the potential of the future.
Everybody thinks they're going to be smart enough to get out before the thing breaks. They thought that at Microsoft. They're thinking that with Google. They're thinking that with Apple. Everybody, first of all, if you ask people, go out and survey people about what kind of drivers there are, 80% of the people will tell you they're above average drivers. Now, if 80% of the people are above average drivers, then how can you have average drivers? It's the same thing. Most people think they're smarter than they are, and they think they're better at picking stocks. And when you sit back and say, well, a company's done this well over this period of time, okay, and extrapolate out in the future, that's one of the dumbest mistakes you can make. What you have to do is say, okay, this is what it's done in the past. Now, let me look at the company, see what's doing now, and where is it going to go in the future? Because nothing that's in the past is going to make any difference for the future of the company.
Yeah, certainly good information because we've seen it here. We've seen it now with things like Microsoft and places like that. So
every company will stumble and fall at some point in time. I don't care how good they are or what they're making. Eventually they stumble and fall. The question is just when.
And how are you smarter than everybody else?
I'm not.
Not you.
I'm certainly not smarter than anybody else, and I'm willing to admit this. So,
right.
I've been doing this for 40 years, and I'm not smarter.
That's why you avoid the 10 common mistakes, and you're not chasing things.
We try really hard to avoid them.
Well, Dennis, thanks so much for joining us. Stick around for a few minutes. Right. Dennis is going to stick around, and Mr. Scott Appert's going to come back along with Ms. Heather Moore. We'll be right back after this break. You're listening to Brashenomics.